The most important drivers impacting the price of gold today: Federal Reserve monetary policy, the U.S. dollar, inflation. All these things we will talk about with our next guest, who is an expert on all things to do with gold, gold miners, and the current state of our economy. He is Axel Merk, CIO and founder of Merk Investments. Welcome back, Axel.
Great to be with you, David.
Great to have you on as always. Last time we spoke was on a day when the gold price fell dramatically. Well, for gold anyway, it was a day when gold fell 2% in one day a few months ago. Now, a lot of sideways action since a few months ago. I want to start by talking about the gold price, and I do want to point out this chart that I prepared for you and the audience. This shows the long-term price of gold going back to 2008. Now, I've circled the local highs of the last two bull cycles. So in 2011, and of course, the last time we had a high, which was 2020, and this year, retracing close to $2,000, we reached 1930 in March. Now, I'm just pointing out the fact that just from a purely technical perspective, these two tops look somewhat similar. Let's assume that the pattern continues to follow what happened in 2011. Then we can see a continuation of this downward price spiral all the way down to a 43% decline from its highs, which is exactly what happened in 2015. Gold troughed at around $1,000, which was a 43% decline from the local top of around $1,900. $1,700 was the last top in 2012. Now, if we assume that the same pattern will happen again this time, we're going to expect around an $1,100 minimum trough for the next bear cycle of gold. That would represent a roughly 43% decline from the last high we got in March, which is 1930. So two-part question, Axel. Can we expect to see this price pattern to reflect what happened 10 years ago? And if so, can we see $1,100?
Well, that would kind of suck, wouldn't it, if you're a gold investor? I'll give you one or two reasons why it might, and then several reasons why it is unlikely. Okay. First of all, I think investors should be aware that this is a possibility. And so if you can't stomach that sort of decline, it's better to lighten up now than at that time. Because historically, you mentioned last time we talked was a high volatility. We haven't really seen the dramatic volatility we saw in those years. And so gold is a volatile investment. The one thing in favor of a sharper decline is high real interest rates. And the other one in favor of that is more constrained fiscal policy. The latter is actually more likely if we get the gridlock in Congress, that we get less spending. And that is a headwind to inflation. On the real interest rates, and here I'm not talking, well, you can talk about the short-term CPI. Inflation is quite possibly going to come down. My own view is it's going to be volatile, but there will be some readings that are going to be lower. Mm-hmm. If you think that the Federal Reserve is going to be able to remain as tough as they are, that they're going to be able to pursue its higher for longer for a very extended period, then the price of gold may well come down, and maybe significantly so. My interpretation of where we are in the price of gold in the context of these higher and higher rates is that the gold investor is calling the bluff of the Fed, so to speak, that the gold investor does not believe the Fed is going to be able to be higher for longer, that it's a convenient policy today, but that they will blink at some point. And we can talk about the scenarios in which they will blink. But if you think we'll have a Volcker type of environment, then yes, gold may perform poorly. If you think that we'll have some sort of event that will get the Fed's attention to pivot, then I do believe gold is going to be okay. One other item maybe to mention, aside from gold, the gold miners, of course, suffered during that period as well.
Yes.
Gold miners are in a dramatically different situation. Back in the previous cycle, they had overinvested, acquired at way too high prices. And in recent years, especially the senior miners, have gotten the balance sheet in order. And so the miners are in far better shape. So even if the price of gold were to drop, I do think that the bloodbath, so to speak, it wouldn't be as severe as it was back in those days.
Okay, so it really comes down to inflation and the Fed. So let's talk about these two variables, and I would like to get your overall outlook on the gold price towards the end of the interview. Now, let's talk about inflation. Headline CPI came in at slightly lower than the previous month, so the September reading for headline CPI was 8.2%, down from 8.3% in August. This was a fourth month in a row that the headline CPI dropped. Recall that it peaked at 9.1% in June. Interestingly, Axel, the core CPI, which is inflation stripping away food and energy, that has continued to increase, not decrease, as its headline counterpart has. Why are we getting this difference here?
Yes, it's important, and it's important to understand without being too much of a data nerd. And importantly, the folks at the Fed are only now starting to realize that this is relevant. When headline inflation goes up, it's because we have a supply shock. It's food and energy going up. The reaction to supply shock, of course, should be different. It shouldn't be a stimulus check because it makes matters worse.
Yes.
And on the core side of things, one of the key drivers, a huge weight, is this so-called owner's equivalent rent. And for years, core CPI was lower because of the way that home prices factor in to inflation. And now we have the opposite. And for months to come, even as home prices are coming down, we'll continue to see inflationary pressures in core and CPI. So it's going to be a huge mess for the Fed. Part of the reason is that when you're hit with high inflation, which is the risk of stagflation, we have these ripple effects. And part of the reason why inflation doesn't just come down in a straight line is because it kind of vibrates and propagates through the economy, affecting other areas. And the problem is that the policies I mentioned, the stimulus checks, tend to be counterproductive. And so the folks who say, oh, great, we'd be higher for lower, inflation has come down and we'll live happily ever after. It doesn't happen in practice. I think I cautioned last time we spoke, we may well have a stagflationary period for an extended period. It's going to be a rough environment because politicians want to do what's popular, which is often the wrong reaction. The supply chain issues, which may well get resolved, but we'll have other challenges. And so you similarly see in the headline CPI and the core CPI some volatility that confuses everybody.
Okay, so do you think that the core CPI can come down eventually? Like you mentioned, when headline CPI goes up, it's because of supply chain issues. Well, you know, COVID is over, right, Axel? We're not supposed to get supply chain issues anymore.
Well, no and no. I mean, the first no I say is that linear thinking that you're implying in your question that most economists and market observers are thinking. When you've been hit with high inflation, it is volatile. Bernanke, I don't like most of what he says and does, but in his recent book, he wrote that if we had high inflation and had it consistently, it may not be good, but we could plan for it. The problem with high inflation is it doesn't just come down and stay there. Even when Volcker beat inflation in the early 80s, it took years until Greenspan got it down to 2%. And so we're going to have these flare-ups, and we may well get several readings that are good, and then the Fed is going to declare victory, and guess what? Then the next report is going to get higher again. That's really the big challenge.
Let me ask you a different way then. So going back to your statement about headline inflation being driven up by supply chain issues, while it's been coming down, headline inflation has been coming down. So let's strip away food and energy. Let's strip away the supply chain issues, okay? We've got core CPI, which is everything else. That's been going up. Why has that been going up? We haven't seen, increases in M2. We haven't seen the Fed reinitiate quantitative easing. Why has core inflation going?
It's owner's equivalent. A third of the core CPI is owner's equivalent. It's something that the Fed has really very little control over in the short term. Keep in mind, those things act with a huge lag, and the methodology is not a good one. And then on top of that, the Fed wants to act with a lag being higher for longer. And so all of that sets us up for big trouble. Separately, of course, we continue to have wage pressures. We have too many folks that are too many job openings versus the folks looking for jobs. Yes. And so there are two ways of fixing that. And the one tool that the Fed has is the sledgehammer. You could open the floodgates of immigration, and doesn't need to be illegal, it could be legal immigration. Then you have a greater supply of labor, but that's not politically attractive. On the supply chain side, sure, we are fixing some issues, but we have a trade war escalating with China. I'm not saying it's a bad one, and that we should let China get away with everything, but that's inflationary. We have the reshoring going on. We have a war going on in Ukraine. All these things will persist. Now, will our wonderful gadgets be produced in a more timely manner? Yes, but there are lots of cross currents that will keep inflationary pressure. Now, that said, the year-over-year comparisons, the so-called base effects, they're going to fizzle out. And so we will soon have inflation readings that look much better, but that doesn't mean we're in the clear. And I think we talk so much inflation. What the Fed really wants to see is that things break. I'm not even being cynical about it. That's what it is to tighten financial conditions. And we've seen it flare up like the issues in the UK. More things will break. The Fed can rarely ever keep tight policy as long as they want to, because things will break that gets their attention. And that's why I've seen the increase in calls for pivot, including the Bank of Canada, as we're talking, raised less than expected, for example.
Okay. So I do want to touch on the notion that more things will break. I want to drill down a little bit deeper here. You brought up, and we'll talk about the Bank of Canada. You brought up owner's equivalent rent. I do want to show you the second chart, which is the Case-Shiller home price index here. Now, this ties into rent. It's not the Case-Shiller home price index. It's a home price index. It's not a rent index, but typically there is a correlation. Now, it's been slowing down. As you can see, it's peaked earlier in the summer, and we're starting to see a decline in home prices. Now, again, going back to my gold question, which is a worst case scenario, I'm not positing it will happen, but recall that in 2007, 2008, we saw a decline. The Case-Shiller index did not recover to its pre-2007 level until 10 years later, Axel. Will that repeat?
Well, it depends on what sort of pivot we'll have, whether we'll go back to zero and whatnot. In 2007, housing was far more important to the US economy than it is today. It's still important, but not as important. And a key driver, everybody blames the big bad banks, but what a key driver of what caused the housing bubble was in 2004 that the regulator of the Fannie and Freddie, the GSEs, forced them to buy much worse issue mortgages of much worse quality. And we have some of that, but much less of that. And so the systemic fallout, so to speak, of the housing prices coming down is less, but it is important. Housing is the most levered investment that most people have. And when they do decline in earnest, it is a problem. It is a problem to household balance sheets. It can be a household to some businesses. So for the time being, it's not a big concern. But back to the Fed policy question, the way it factors into inflation has about a 9-month lag. On top of that, the Fed has a lag. And so the Fed will be hopelessly late in reacting to that. And in that process can well create a lot of damage. Now, on the flip side, when they do pivot, gold and gold miners tend to be the early ones to react. And so that's part of the reason why I don't think we'll see that many years of a bear market that you showed in the early chart.
Okay, so going back to the Bank of Canada, as we are speaking today on the 26th of October, they raised by 50 basis points, which was a smaller rate hike than expected. All around the world, we're seeing central banks sort of reducing their hawkishness or being a little bit more cautious. The Bank of England, for example, on the 22nd of September, announced that the UK was in a recession. They hiked by 50 basis points. And at the same time, they're commencing bond purchases. So they're raising interest rates while also doing a sort of QE. So this is a bit of a mixed signal from the Bank of England, the Bank of Canada I just mentioned. When can we expect, let's go back to your core question, the pivot. Everybody's wondering about the Fed pivot. When can we expect the Fed to reduce its hawkishness as well?
Well, let me first talk about the Bank of England QE and tightening.
Yes.
The ECB has something similar. The ECB has come out, will raise rates, but if the peripheral spreads, the so-called PIGS countries, if these spreads blow out, we'll buy those. So the whatever it takes still applies. And so similarly, as I mentioned, right, the whole point of raising rates is to break things, but central bankers think they can cover that up with QE or whatever tools that they have. And so my guess is that as we continue to raise rates, we'll see more of these red flags, and we'll try to patch them up. The question is, how many band-aids can you apply? Keep in mind, the Fed's role is to be focused domestically. And so, yes, they'll read about what's happening in England. What they should do is an all-out investigation in what's happening in the pension funds in the US. Treasury markets are, of course, much more liquid. So if you have to liquidate things, that's a little bit easier. But when John Williams, the Fed president in New York, was asked any concern, and he said the other day, well, core markets are functioning. Well, those are the reverse repos. So if we have to wait for that market to blow up, we'll never have the Fed stop. In practice, what will happen is something will happen that threatens the stability of the financial systems that we may not be even aware of. And at that stage, they'll say, oh, I guess we did too much, right? And so that's usually what happens. So you can look at what's priced in, but almost always the Fed has to act earlier than is priced in, because the tightening will have implications that go just beyond the mandates of price stability and full employment, because financial stability is ultimately the one and only mandate that they really, really care about strongly.
Financial stability? That's not even one of their official mandates.
Well, the Federal Reserve is a club of banks, and the survival of the banking system is at the core of what they do. And so, yeah, it may not be written as the mandate, but ultimately, I mean, look at 2008, right? The reason we had all these quote unquote emergency tools is to save the banking system.
Interesting. Very interesting perspective. Okay, Axel, let's talk about going forward then, your outlook going forward. The Fed needs to see things break. Let's expand on that. That was your statement from earlier. What is going to break? What more needs to break than what's already been broken, Axel?
Well, this goes in the context that this is a recession everybody knows about, right? Everybody knows they hike. Everybody knows that you'll have to stop at some point, and everybody is waiting for what it will be. The warning signs, we talked about the Bank of England. The other item that I keep an eye on is what sort of loans the Federal Reserve gives to other central banks, the so-called swap lines. They've been activated to Switzerland. And so these are the little canary in the coal mines. We don't know where the next fire will be, but it's all but certain, in my view anyway, that there will be other fires, because raising rates makes it more difficult for those who swim naked to finance themselves. And so something will happen. After 2000, we had some tightening and we didn't have a major crisis. That's possible. There's also a possibility after World War II and from 1946 to 49, we had a tightening without a major crisis and inflation fizzled out. That's a possibility, not my baseline scenario. My baseline scenario is there's going to be volatility, something will break, and we'll have to wait and see. And it doesn't really matter. The relevance to gold is gold tends to be reacting earlier than equities. It could be that we have a severe recession. Most equities bottom out late, whereas the gold miners and gold level out much earlier, early signs of that pivot.
There is this view out there that at a certain point, we're past a certain point, the economy is just going to be on like a runaway train, is the analogy. Meaning that it doesn't matter if the Fed pivots tomorrow, Axel. Let's say they start reducing rates tomorrow, a recession will still be inevitable. Is that a view that you share, that at a certain point, there is nothing the Federal Reserve can do to prevent a recession, if we're not already in one?
You use a sledgehammer to whack something. At some point, the thing is going to crumble, right? I mean, as I try to make clear, that the indicators the Fed looks at are hugely delayed. They have all but promised higher for longer, means they're promised to be late. They have lost credibility, so they're more concerned about gaining credibility than any of the other things. And so it's all but assured that we get a recession. Now, could it be that we're lucky and don't have one? Yeah, that's a possibility, but it shouldn't be anybody's baseline scenario based on what the Fed has promised to do.
Okay, so what's your outlook for the gold and gold miners? You mentioned that they're a leading indicator ahead of stocks. You mentioned that typically they rebound after a recession. Can we see a rebound anytime within the next year, Axel?
Yeah, so stocks tend to rebound about 2/3 through a recession. I don't think we are in it quite yet, based on historically how we look at it. Obviously, many people will feel recession. As far as gold is concerned, one thing I look at is longer-term real interest rates. So something like the TIPS yield, and we may have peaked there. We're currently at around 1.5%, a little above that. We were higher than that. And so if we come down from there, that's a very much something to look at as a positive sign, as a positive catalyst for the price of gold. And so, but ultimately also, of course, it depends how things play out. But I do think that more and more Fed officials are concerned about the financial stability considerations. And so it's always relative to what's priced in. We had priced in a peak rate of 5% in the cycle. We've come down from that. And so those are the things to monitor. And then the other thing is, of course, gold historically has served as a diversifier, and it's done less of that role, more correlated. Everything has been correlated. Those correlations, when they come together, they break apart again. And so I would think price of gold is gonna resume its role as a diversifier. And so we'll have to see, right? I don't have a crystal ball, but I do think that the sledgehammer approach will break things. And when things recover, gold miners are going to be one of the earlier ones to recover.
I do want to ask you a final question. I'll let you go, Axel, about gold's role in hedging against geopolitical risk. There's talk of escalations in Ukraine, talk of escalations from Putin, and also from the West's response to Putin's military escalations. What is gold's role in all of this? I do want to bring up the fact that gold did climb in the initial days of the Ukraine invasion. However, if you look at real interest rates, like you pointed out, real interest rates were already dropping several weeks before February 24th, and gold was already climbing up. So I wonder how much of the rise to the peak in March this year was due to Ukraine.
Well, I think you framed it right. Gold does react to geopolitical risk, but the world gets used to geopolitical risk, which means there tends to be initial flare-up. I don't like those sort of flare-ups as a gold investor because it tends to revert. When we have a terrorist attack, people get used to these things, as horrible as they are. I happen to think of geopolitical risk. What Putin has done is a taste of what we may see going forward, in the sense that the US is less involved as a global policeman, and that will create more crises. And the question, gold is a diversifier in that. Ultimately, I think it matters more as to the financial stability and sustainability of US finances for the long-term health of the US dollar. By the way, we didn't talk about that. I do think that as the Fed pivot, we might get a secular dollar bear market coming out of this. And then we'll have the occasional flare up of a crisis, and probably at an increasing pace. That will support the price of gold, but I don't think that's going to be a key driver in gold in the medium term.
Understand it. All right. Thank you, Axel. Very good insights. Thank you for joining us today.
My pleasure.
And we'll speak to you again soon. Thank you for watching Kitco News. I'm David Lin.